Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I'm Paul Winkler, talking money and investing. So, one of the things that I talk about on this show all the time, and I'll stand by, is the show is about educating you as the investor, talking about the news of the week, but also talking about research areas, things that you, as I believe in my humble opinion, need to know about. And the reason is that blindly trusting the investment industry is not a good idea. It has never been a good idea. The industry has not necessarily been a great advocate for the end investor, as is evidenced by the research by companies like Dalbar that actually look back over 30 years and look at actual investor returns versus market returns. And we see it anecdotally. When we look at investor portfolios, we see that they're terribly they're poorly diversified. I mean, just really missing many different asset categories, and they're typically funds are bought based on past performance. And here's the problem with past performance, of course. It sells, but it's really not such a great idea because what ends up happening, investors end up buying after something has done well. And of course, you weren't there when it did well. And this is how they did the research. Matter of fact, they were looking at when money flowed in and when money flowed out. So they were trying to figure out, estimate what returns actually were for investors in equity mutual funds and asset allocation funds and things like that. Asset allocation being dividing between stocks, bonds, and cash and various investment asset categories. And what they found is investors would, after something does well, they go, wow, this is doing really well. This makes sense. I'm going to buy this. And then after they get in, maybe they don't have the performance they were expecting. Expectations are everything. If you expect, a certain level of return and those returns are below what you expected, then you get frustrated and then you start to pull out and you look for something else that has done better. During the most previous period of time, of course, right? You can make the same mistake over again. Insanity is not an unusual thing. Then what we do is after it does poorly, we get out and then it ends up going up and then we're not there when it ends up going up, and it just goes back and forth. And this is what happens with people. And I was reading something it was quotes from some famous person. I don't even remember who it was, and it's probably best I don't remember who it was. Because he made the comment that I'm not much of a rear view mirror person. I'm more of a windshield person, I think is what he said. And I thought, well, a lot of times I've said that. You don't rear view mirror invest. But there are certain things in the rear view mirror that you can learn from. You can learn from history. Where do returns really come from? So if we look at various market segments, what is the expected return? Now, it is not driven by some fund manager's ability to get in, get out, buy the right companies and all of that, but it is the asset categories tend to have a cost of capital. Just like a person that lives in a poor area of town would have to pay more interest to borrow money than a person that is really good about paying their bills every single month. A company that is more risky has to pay more to use your money. So in effect, what I'm doing when I'm just going out and I'm looking for companies that had great past performance or that they're performing well, maybe their business model is good, they don't have to pay much to use your money. I don't care how popular they are and how much they're likely to be successful. Their success is already baked into their pricing of their stocks, and therefore the expected return in the future maybe actually lower than many other areas of the market because they don't have to pay much to use your money. Now, that leads us, there was a segment on CNBC this week I was watching, and I like to just pick up, what are people talking about? And they had this guy, he was the CEO of a large corporation, and he was talking about sustainability. He was talking about when we talk about ESG investing, for carbon emissions and all of these types of things. More about that in a second. Some eye-opening stuff about that in a second. But what even for me. So what they were talking about was, hey, we're looking at doing this and we have these goals in the future. We got to meet these goals in 2040 and 2050 and this is what we're shooting, but we don't want to wait till last second. And one of the guys on the show is not known for being terribly conservative, makes some really good points. And then the guy that is more conservative actually ends it really well. So you just need to check out this segment and listen to what they say here.
Sure, but for us, we made sort of a midterm goal because we said by 2025 we've got to decrease by 10%. Because it's really fun to sort of talk about 2040, 2050 because it'll be 2 years from now. And I think you've got to have some goals that are a little bit nearer term.
But as the economy gets more challenged, actually, how many of those pledges do you think you start to say, you know what? Well, we got to shift here. I know it's a credibility issue to some degree, but at some degree, it's also a practical issue.
That's when the lights start going out. That people start putting sweaters on in Europe. The reality of these things set in, and it's great to have these goals.
Yeah, exactly. Really good point. That's Joe Kernan at the end. When the lights go out and you're putting sweaters on, you can't heat your house, then all of a sudden, all these great ideas that you had on meeting sustainability goals and meeting your goals for carbon emissions and all of that stuff, maybe it needs to take a back burner. And that's just it. What's happening is a lot of companies, you wonder, what on earth are they thinking? And it's political posturing. You got to recognize that whoever's in power in Washington, they can make your life a little bit difficult as a company, as a CEO of a company. So you kind of understand it from the CEO's perspective. We all do things, right? And sometimes we go, why is that person doing what they're doing? And, you go, well, actually it makes perfect sense to them. And you'd probably do the same exact thing if you were in their position. And that's just it. So that's why you wonder what's going on here. But that's why, because they've got to do things that are going to be best for their company. And they may talk a good game. And you don't know what these people believe in, actually what they're saying, because they have to play the political game. But that's the reality of it. A lot of this stuff that you watch companies doing, and somebody asked me about this week, and I said, well, a lot of times companies will do things, and they jump on these bandwagons so that they get lauded by the media, and because think about it, it's free advertising. When the media is talking well of you, that's free advertising. And when you're CEO of a company, you want all the positive press you can get. And then, you can have a few naysayers and people saying that, what you're doing is awful and all of that, but it doesn't typically offset all the positive press that you're getting someplace else. So you can see why they would engage in this type of thing. But here's the thing as the investor. I've never been a big fan of this type of investing, the environmental, social, and governance investing, ESG investing, just simply because I look at it as you're looking at companies, maybe they're well-run companies and they're great companies. But remember, if you own nothing but the greatest companies of the time, you have to pay a lot for them, and then your expected return is lower historically, was what we see with that. Well, when we invest, what we want more returns. Now, there are companies that, let's just go in a totally different direction. Forget about ESG, but think about just companies that were putting out product that wasn't that great. Back in history, we call them value companies. And when they turned around, it was incredible, the rates of return that came out in the future when they turned around. As you've heard me say before, if you listen to the show, that's 96% of 20-year periods. Value companies outperform growth companies. But a lot of times what you're doing with ESG is you're investing all in very growthy companies. And the bigger they are and the higher the prices, the further they have to fall. So it can be very, very risky. So you think, and you watch these programs out there and you hear commercials and people say, hey, you know what? We're a fiduciary. We're a fiduciary. We've got to keep your best interest first as an investor. Isn't that great? And I look at that and go, I am not a big fan of that rule. Not because I don't think that the investment advisor ought to keep people's best interest first, but the problem is they can't. And what do I mean by that? If you, let's say, look at the level of education it takes to become an investment advisor, the bar is not that high. Let me just put it that way. I've got one guy that works in here, and we have talked about this before, but it bears repeating. He came to me one day and said, hey, I'm thinking about taking the test that allows him to actually advise clients and be an advisor. And he was a new advisor at the time. He hadn't worked here that long. And I said, yeah, great, go ahead, go do that. And 3 weeks later, he's passed the test. And now now he R1. As they say, I couldn't spell advisor before, but now I R1. And what happens is that the investment industry, that's the bar. And then, some people say, well, CFP, Certified Financial Planner, Chartered Financial Consultant. And I'm a big fan of those things. And matter of fact, everybody that works with us has one of those two designations. But I don't think that's a high enough bar either. There's too much. When you look at the curriculum, let me just talk about this a second. When you look at the curriculum, the problem is that who pays for an advisor to go through the curriculum? Well, investment companies do, right? So an investment company pays for the advisor to go through it. Now, you have a big investment firm, and they're sending one of their new employees that they want to be gung-ho about their product lineup and sell their stuff to the public. And they send them to a school that says, hey, a lot of stuff here that your employer's doing is really bad. And it's, subject to all kinds of conflicts, and it's problematic. Then the employee comes back to the employer and goes, hey, all the stuff we're doing is bad. You think the employer would be really happy with the educational institution that just ruined their new employee from their perspective? No, I don't think so. So what happens is they're diplomatic so often with the information, and they'll say, hey, this is something. They'll teach some of the right stuff. That's the reality of it. They will teach some of the right stuff, but a lot of the stuff that they teach will be in alignment with what the employer actually wants the employee to learn. So therefore, what happens is the employee comes back with a little bit of confusion. They don't know what the right answer is, and because they don't know what the right answer is, they're not a harm to the company in terms of moving product. And that's just the reality of stuff. So what ends up happening is that the advisors, a lot of times, they don't, and this was evidenced by, I've talked about this, the Indiana University USC study. And what they did in that particular study was they looked at investment advisor portfolios and they said, hey, you know what? These people are making bunches of mistakes. And then what they did is say, well, maybe it's because they're trying to sell the product of their employer, the company that they work for, and maybe that's why they're making mistakes. And then they looked at it and they said, oh, wait a minute. Even after they retire, they're making the same mistakes with their own portfolios and ignoring a lot of the academic research that shows that what they were doing, and they're actually underperforming markets as a result of not following this. So it's not just, hey, sometimes we give academics a bad name. Academics, better not pay attention. No, they're biased. Well, the reality is we have a benchmark that we can go by. In other words, we can look to see if the research actually works or not. It's not just somebody's opinion. I can look at somebody investing in large U.S. stocks and say, well, did they get a higher return than what large U.S. stocks went up anyway? So it's an objective way of looking. It's evidence-based, as we call it. So I'm not just going, hey, I just disagree with that point of view. No, it's the return was lower than large U.S. stocks, or the return was lower than the S&P 600. It's lower than small U.S. stocks, or the Russell 2000, or it's lower than the Russell 2000 value, the Europe, Australia, Far East Index, or whatever. I can actually look at the area of the market they're investing in and see that they have underperformance. So it's an objective way of looking at things. Well, they found that they were actually making mistakes that were harming even themselves when they had no incentive to do so. So we look at that and say, okay, well, it seems that maybe the advisor didn't know what they needed to know, and therefore to keep somebody's best interest first would be impossible. That was basically the premise of the study, University of Southern California, Indiana University study. How do you hold somebody to a standard when they don't have the high enough level of education to actually do what's even in their own best interest. So then what they did is, so they said, this is a problem, which is a good conclusion to come to. And I was talking to some of the guys in the office this week, and I said, it's kind of like saying you've got to have the absolute best heart surgery that there absolutely is. And the problem is that, you bring in this doctor and say, okay, doc, you need to do what is in this client's best interest when you're doing this heart surgery. Absolute the best work that you can. And the problem is that the heart surgeon is, the person performing the heart surgery is a GP and doesn't do heart surgery. Or, maybe a brain surgeon. I mean, maybe actually very well educated and qualified, but not qualified to do what you need them to do. But, so what ends up happening is that the person doesn't get, or the investor doesn't get the experience, and it's not because the person wasn't trying. Okay, so that's the problem that you run into with a lot of these standards. So with the fiduciary rule, what it does, and the problem that I have with it, is that it basically says, hey, you got to do what's in the client's best interest. Well, I see people come in and they're working with fiduciaries. They're working with companies that market themselves as having to keep the client's best interest first. They don't have the conflicts of interest or commissions or anything like that. And yet they're investing in ESG investing. They're investing in gold. They have commodities in the portfolio, have zero expected return after inflation. They're not investment. There's no cost of capital. But that is something that markets well with people because they think it makes sense, but they don't really understand investing principles. They're actively stock picking and market timing. They've chosen mutual funds based on past performance. And criteria that actually are not helpful in choosing investment vehicles. They're not abiding by some of the research on how to put things together, investments that have lower correlations so that you keep the level of volatility down and you're maximizing expected return for given levels of volatility. There's Nobel Prize awarded for that, but they're not abiding by it. So this, or crypto investing, I see some of that kind of stuff going on. And you go, well, wait a minute, how are they keeping people's best interest first? Wait a minute, how is this actually happening? And the answer is, it's not really the intent of the rule. You can have people doing things that is not necessarily in the best interest of the client from a return perspective, but maybe you're not front running. Maybe you're not going and buying something ahead of your client and then telling your client to go do it. Or maybe you're actually trying to choose a lower cost version of the investment vehicle or disclosing conflicts of interest or things like that. And you could be doing things that would be in line with the spirit of the rule, but not necessarily that great for the investor. The reality of it is, this is something that somebody asked me about one time. It was a compliance person say, hey, Paul, you recognize that when you said something about this particular investment vehicle, it was investment advice in this particular instance, and you got really need to watch yourself. And I said, well, I absolutely believe, based on the academic research, that that was right. And they said, yeah, but wait a minute. Some people just want to stock pick and market time. And I said, well, it's imprudent. Doesn't matter. They still want to do it. And I said, you know what? It's so funny you say that. Because I actually used to teach a workshop years ago, and I forgot my own workshop, where I would say, you can choose your investment philosophy. Do I believe that stock picking and market timing are a good idea? Or do I believe it's not a good idea? Now, if I believe that stock picking and market timing are a bad idea, and I look at the academic research, I look at the evidence and go, yeah, this doesn't tend to give us good results. It's like 96% in the most recent SPIVA study on small cap stocks, small cap fund investors, 96% of them underperformed what the market did. That's pretty bad odds. 96%, that's pretty bad. 4% chance of outperformance. Or you got like 8% on the side of large U.S. stocks. And so in most asset categories, they actually track investment managers, professionals versus market segments. And they look at it and go, yeah, the odds aren't so good. They aren't so good of coming out of this well. But if you are the client and that's what you want your investment advisor to do, I want you to do that. I want to be involved in ESG investing. I want to be involved in cryptocurrencies. I want my fund manager to go out and look for people that they think are going to do better. Who's to say that, you've chosen that investment philosophy. You wouldn't be happy. You wouldn't be happy if somebody wasn't doing that. Now, even though statistically and evidence-based wise, we look at the research and say, historically there's lower returns when you do that, it doesn't matter. You want that, and that's what you want somebody to do. As long as they do it in a low-cost fashion and meet all those criteria, they can manage your portfolio in what I personally would call an imprudent manner and still be abiding by it. This is why it is so critical that you don't turn a blind eye. And that's exactly the problem I have with this rule, is that investors thinking, my investment advisor is just going to make sure that they're going to be a fiduciary. They're going to keep my best interest first. That's it. That's what they're going to do. And I can go on and do my other stuff and go hang out with the grandkids or do whatever. I don't have to pay attention. And that's the problem. It causes, in my humble opinion, the investor to stop paying attention because they don't think they have to pay attention because the advisor is being held to some standard that they don't have to worry about it anymore. That's the problem. It is an issue that I think going forward is going to become more and more of a problem.